Welcome to Sprott Media. I'm Albert Liu. Today is Tuesday, March 3rd. I'm joined on the phone by Rick Rule, President, CEO of Sprott U.S. Holdings, and he joins us today from the PDAC annual Mineral Exploration and Development Conference in Toronto. Rick, thanks for joining me here at Sprott Media. Just a couple days into the conference there, what are your thoughts so far on PDAC?
Well, it's very interesting, Albert. Attendance is down this year, not surprisingly, as a consequence of things like the coronavirus. When I say down, it's probably down to 24,000 people. It's easily the largest mining convention in the world. So, there's, 3 floors of exhibitors, equipment suppliers, host governments, mining companies, financial services providers, a real sort of smorgasbord of every possible sort of vendor related to mining. For me, of course, it's an absolute must-attend event. It's the most important mining convention of the year. It probably saves me personally 100,000 air miles by having people from everywhere under one roof.
Rick, you probably are able to get a barometer on what's going on in the gold market or in mining in general, just from the people that you speak with, the people who request meetings with you. I'm wondering, how is this year different from prior years?
Well, there's 2 predominant themes in the precious metals side. Those people who are in the physical business, that is, they are actually investing in or selling or buying physical precious metals, bullion specifically. And there is a not very quiet confidence. There's a uniformity of opinion in the gold business that several factors are converging, which are likely to take bullion higher. You're familiar with all of those, of course. Quantitative easing, low real interest rates, lack of faith in the economy, all those types of things. I would suggest that the gold industry, the physical gold industry, feels that if the Fed does cut interest rates by 50 basis points, that's probably the catalyst for a real romp in the gold price. The only thing about that thesis that scares me is the unanimity with which it is held. In the mining equities, on the other hand, there is a brave face being put forward. Many of the issuers didn't come to market in the last 4 months, although they needed capital, because the market for the shares was going up, and they thought they'd be able to raise money at higher share prices, i.e. a lower cost of capital. They played chicken with capital markets, and as a consequence of the market disruption that they've seen, there's some fear on the part of those people that they have lost that bet. So while the junior mining industry at least is putting a very brave face forward, there is the real sense that capital markets are closed for some period of time. Nobody knows how long it is. The volatility that we've seen in equities markets, depending on your point of view, is either good or bad. But from my personal opinion, of course, it's good. I like to take advantage of volatility. But the truth is that it has unnerved people in many regards. The extraordinary sell-off on Friday, and then with many people believing that the sell-off would continue to Monday, and Monday being a fairly strong up day, I would suggest that the investor sentiment here on the floor is merely confused.
I was going to ask you that because you are a highly sought-after interview guest at these types of conferences, and I'm wondering, from the retail perspective, what kind of questions are you getting from the various interviews that you're doing there?
It would seem that what the interviewers would like me to do is hold their audience's hand. I think the real advantage that I have in those interviews is simply age. I've been through this before. I think that the sentiment is pretty realistic right now. There is a widespread belief, I think, that gold as an asset class is going to do well. There is some trepidation about gold equities in the near term, and probably some confidence about gold in the long term. Some of the questions, of course, are beyond my capabilities to answer. People have asked me a lot of questions about the virus itself. And Albert, as you know, I'm no epidemiologist. So, I've had to respond to those that they're above my pay grade. But people do seem to be looking for reassurance as much as anything else. People are looking, in many cases, to have things that are unexplainable explained. There are other portals, web-based information distributors who have asked me questions that are probably more contrarian and are saying, so where do you see value here? What are you doing? So there's really been a range of questions.
Those are all great questions. Some of them, I admit, cannot be answered, but those are oftentimes the most fun to ask, Rick. I'll try to keep mine sort of more down your alley. We have to acknowledge, or we can't avoid acknowledging, what's going on in the media right now with this scare, the coronavirus scare. And I wonder, let's try to add some perspective to the investing side of this. On the personal side, there are people, Rick, in our neighborhood going out and buying 3 to 6 months worth of food and other provisions. And incidentally,
Right.
The market seems to be going into the tank, but I can tell you Costco is probably going to have a great quarter. People are going crazy there. And when I'm asked about this, I just tell people from my own experience, non-expert experience, that whatever makes you sleep at night, it's not harming you, go ahead and do it. We may be overreacting to certain things, but I wonder if we're underreacting to the possible economic fallout from this. Because if we do indeed have a bubble, and 19, 20 multiples on broad general equities is certainly within that category, it doesn't take a large catalyst or pin to pop a bubble like that. So do you think we've been underestimating the potential economic fallout from this?
I think you are likely onto something. I think that a rate cut would at least temporarily help the equities markets. The sense that for the last 25 years, anytime there was a problem, we exercised the Fed put. We cut interest rates, we added liquidity to the system, and the sort of animal forces took care of the rest. I think there may be broader issues with regards to the economy, and I think that those broader issues are probably of specific interest to Sprott clients. While it's arguable that almost any likely policy response that might happen would be good for the gold price, the underlying economic implications of, in particular, the slowdown in China, for the rest of the commodity complex is not pleasant. China, as I understand it, these are World Bank statistics, not Rick Rule statistics, but World Bank statistics suggest that China has been responsible for about 35% of global economic growth over the last few years. And as you know, Albert, prices are set on the margin. When you reduce marginal demand, you reduce price much more than you would suspect. So I think in terms of the broader commodities complex, if the coronavirus, as an example, shakes up the availability of capital and liquidity, at the same time that a slowdown in economic demand in China or more generally impacts the broad economy, the outlook for many sectors of the economy, including basic materials, is challenged. Interestingly, for me, I sort of see a silver lining in that my nervousness, as you and I have talked about before, was in a normal economic slowdown, the kind that you might expect to occur after a 10-year economic expansion. My nervousness was that we saw a long, slow, grinding bear market, including a bear market in materials, where the excesses of sort of 10 years of liquidity became unwound in a 2 or 3 year long bear market, including a bear market in materials. What may be happening as a consequence of the coronavirus is that the down cycle, at least in materials, gets compressed from 3 years to 6 months. My suspicion was, and I'm no economist, but my suspicion was that oil, as an example, might fall from $60 to $40 over 2 or 3 long, ugly, boring years. That might occur now over 3 months or 4 months. So in a sense, we may be in the broader commodity complex and maybe even in the broader economy going to experience a much sharper but shorter decline. That's sort of the way I'm feeling. Who knows if that's true? As you know, I'm certainly no economist, and I wouldn't want to speak to the broader equities. I'm obviously concerned about the broader economy because I see the economy as being liquidity-driven, and I think it's been liquidity-driven for 10 years. These liquidity-driven expansions, what really happens is the availability of liquidity forward shifts demand from later periods to sooner periods. And my suspicion is at some point in time, for a while, you simply run out of that demand. We'll see whether or not that comes to pass.
Let's stick with the theme of energy for a second, Rick. Lots of pressure on oil. The reports I'm reading are saying that the high yield markets were essentially closed down last week. Issuance was abruptly stopped. What effect is this going to have liquidity-wise on some of these high yield issuers?
Well, that's an amazing topic. And you may recall, you and I visited on that subject about a year ago. One of the interesting aspects of the high yield market is that so much high yield debt is owned in very, very liquid exchange traded funds, ETFs. And the challenge is that the top structure, the ETFs, are both large and extremely liquid, but the assets that they hold are illiquid. And if you have a panic at the ETFs, it might have the effect that an old-fashioned bank run used to have, where a $50 or $60 billion ETF has a series of $25 million underlying positions, which are themselves very illiquid. As investors go to redeem the ETF, the managers have to sell the ETF issues, the issues in the ETF, which are illiquid, and they can't do it. I think there's a real risk of that. I think, I'm not saying it's going to happen, but a circumstance where you have a highly liquid vehicle whose only assets are illiquid vehicles, if there's a redemption run, it has the impact of a run on the bank. And we could very well see more turmoil in the high yield markets, not only in the issuance, but in fact in the aftermarket for these things.
That's right. And I think the first test was last week. It wasn't what anyone would describe as a run, but there certainly were significant outflows from the most prominent high yield ETFs, and the market appeared to clear. Does that surprise you at all?
I think that there is enough liquidity in the market for now. You'll recall that in the 2008 circumstance, and I hate to make that obvious connection, but in the 2008 circumstance, the unwinding of credit, real estate credit, and the unwinding of instruments in real estate credit took sort of 3 or 4 months to move from worrisome to catastrophic. To the extent that the redemptions in the high yield market are stemmed, and they could easily be stemmed, I think, by a 50 basis point interest rate cut. That is, if the high yield market yielding 5.5 or 6 began to get investor inflows as a consequence of certificates of deposit yielding 0.5%. Then the potential crisis that we described, the illiquidity crisis, is perhaps averted. I can see a circumstance where, at least for a year or a year and a half, that we can skate through this. If, by contrast, even with the 50 basis point rate cut, 2 or 3 or 4 high yield issuers default because of low interest rates or the lack of availability of supplementary bank credits, And the consequence of those defaults cause more high yield investors to exit the high yield market, then I think the systemic risk that we talked about is still high.
Let's move from high yield to the proverbial safe haven. That would be U.S. Treasuries. We hit all-time lows on the yield. And Rick, oftentimes when discussing gold, you talk about the demand of gold stemming or being inversely correlated to faith in the US dollar, and particularly as expressed by the 10-year Treasury. As that yield drops closer and closer to 1%, are you surprised that that can happen while at the same time gold can edge toward an all-time high?
I am. It doesn't make any intuitive sense to me, but I guess the markets aren't designed to make intuitive sense to me. One near-term outcome from lowering the interest rate substantially is that the capitalized value or the capitalized prices of bonds increase, of course. If you look not just at the 10-year, but rather at the 30-year, the long end of the yield curve, a 50 basis point rate cut makes existing bonds relative to the newly issued bonds seem cheap. We're in this odd circumstance right now, Albert, where people seem to be buying stocks for yield and bonds for capital gains. Now, I personally have absolutely no interest in buying a 10-year or a 20-year or a 30-year piece of paper. The idea that the United States proposes to pay me below 100 basis points in a currency where even the CPI stated rate of inflation is 1.6, 1.7, 1.8%. I mean, basically what they're telling me is that my purchasing power is going to disappear at the rate of 70 or 80 basis points a year. I don't have much of a sense of humor for that. I like cash, in fact. So I could see myself in the 3-month market or the 6-month market, but the idea that I personally would be in the 10-year market just makes absolutely no sense at all to me. Not that I make a market.
Rick, I think your information may be maybe 90 minutes old. I think we're talking about 100 basis points now in the market for the Fed. You make an interesting point about equity investors seeking yield and fixed income investors seeking capital appreciation. When you look at the shift in investor behavior, you see the bond market starting to behave more like the equity market in the sense that it fluctuates and it's moody and it chases momentum and those sort of things. That's really interesting. As we close out here, Rick, I just want to ask, how is Rick Rule, the speculator, going to approach the market in the next month, let's say? And how is Rick Rule, the investor, going to approach markets?
I'm going to take what the market gives me first, Albert. If you look at me 6 months from now, I am almost certainly going to be a buyer of the big oil stocks. Not now, but the idea that even now Exxon generates a 7% yield. Yes, they're challenged by low oil prices. And yes, Greta doesn't like them. But they're one of the better capital allocators of our generation. And I suspect that most of us will be driving the petroleum-fueled vehicles for the next 10 or 15 years. So I will certainly be in the big oil stocks over the next 6 months. In the near term, I don't need to buy any more gold and silver bullion because I've been relatively aggressive personally doing that for the last year and a half. But I certainly will take advantage of the terror that I see in the small mining sector to provide capital on terms that I consider to be attractive to companies that need to find capital in a market where that capital is very scarce. The circumstance that we have in front of us, from my point of view, in the precious metals equity space is, really, I think, quite attractive. And the fact that I have very little competition that's willing to write checks at this point in time means that I need to work up the courage to write those checks. And I'm not, by the way, belittling the possibility of increased turmoil as a consequence of the coronavirus. But I remember many intelligent contrarian investors teaching that an event that causes panic that is other than permanent is an opportunity. And I suspect, just like every other crisis that mankind has faced, that we will find a technological or social solution to the coronavirus. I believe that this circumstance is other than permanent. I'm not suggesting that it won't get even more unpleasant, but my training is that when you have a circumstance that is other than permanent, that causes panic, that you must, at least in a measured way, take advantage of it, which is what my intention is.
All right, Rick, we're out of time, but thanks for taking time out of your day to join us here at Sprott Media.
Well, thank you very much for organizing this, Albert. I've found it pleasant, and I hope it's useful to our listeners.